Hello friends, my name is Masood. Today we shall discuss about topic the depreciation. Friend, today's topic is very interesting, especially if you have interest in economy and investment and project management. This is a very common topic we can discuss related to all these two types of domain. So let's start, friend. First of all, I request to please subscribe to my YouTube channel and click on the bell option as well, so that my new videos can reach to you, and also you can follow me on the Facebook page as well. Friend, depreciation, like we have just consider that we have many types of assets. For example, you have a house, you have the you have a car, you have a very expensive watch, you have a laptop, you have the computer equipment. So there are many types of physical things which you have, which you can consider as an asset. Let's take it as an example of the for example, computer laptop. So whenever we are using those assets, like for example you are using a laptop or you are using a house for residence, so with the passage of time the cost of that asset will be decreasing. So basically measurement of that asset decrement is called as the depreciation. Okay, depreciation means that you measure that what will be the value. For example, an asset value is, for example, 5 years. For example, you have a laptop company, you have a computer laptop, and the life of that asset is 5 years. So you will calculate that the depreciation value for next 5 years. Now basically, friend, the depreciation is an accounting method used to allocate the cost of a tangible or physical asset over its useful life. Depreciation represents how much of an asset value being used. It allows companies to earn revenue from the assets they own by paying for them over a certain period of time. Now, first of all, a depreciation ties the cost of using a tangible asset with the benefits gained over its overall life. Also, it includes straight line and various forms of accelerated depreciation. Accumulated depreciation refers to the sum of all depreciation recorded on an asset to a specific date. The carrying value of an asset on the balance sheet is its historical cost minus all accumulated depreciation, and also the carrying value of an asset after all depreciation being taken is referred to as a salvage value. Basically, friend, assets such as machinery and equipment are very expensive. Instead of realizing the entire cost of an asset in 1 year, companies can use the depreciation to spread over the cost and match depreciation expenses to related revenues in the same reporting period. This allows a company or organization to write off an asset's value over a period of time, notably its useful life. Depreciation is considered as a non-cash charge because it doesn't represent the actual cash outflow. The entire cash outlay may be paid initially when an asset is purchased, but the expense is recorded incrementally to financial reporting purpose. So basically, depreciation means the calculation of a cost, a decrement of a cost with overall passage of its life of an asset. For example, you are calculating the depreciation of a house. So you will consider that, for example, the life of a house is 20 years, for example. So so each year you will calculate that how much cost will be depreciated, will be minus with the actual cost. Then, friend, depreciation is an obviously non-cash flow expense, which means that it does not require a cash outflow, but it does reduce the asset's value. Therefore, since the expense has already been incurred, the depreciation does not affect the company's liquidity. However, the depreciation expense is recorded in the income statement. It reduces the earnings before tax and consequently the tax that the company will have to pay. So friend, thanks a lot for watching the video. I hope you like this video. If you like it, please share it with your friends and colleagues, and thanks a lot for watching the video. Thank you, friends.